Welcome, everybody. This week we're going to break down the stock market in 5 minutes with our investment expert, VP of Financial Education at Sqwire, Casey Halliley. 5 minutes is going to be amazing. I cannot wait to see how she's going to talk so fast that it sounds like one of those car commercials at the end. But I think she can do it. Casey, have fun with this one. This is going to be great.
Everybody, there's no possible way I can describe the stock market in 5 minutes, but I'm going to try my best. Here we go. A stock is a small piece or a share of a company. And when you buy a share of stock, you own equity or a tiny slice of the company that you're buying. So you're going to make or lose money in equities in one of two ways. Number one is when the price of the stock, not surprisingly, you bought goes up and you sell it. So if you buy a share of a stock at 100, and it goes up to 150, and then it goes down to 75, and it goes back up again, you haven't made or lost any money at all. You only make or lose money when you actually sell that share of stock. And prices of stocks, as I'm sure everybody knows, go up and down almost every single minute of every single day that the stock market is open. And I just want to reiterate that it doesn't matter until you actually make the decision to sell that share of stock. So if you buy a share of stock at 100 and you sell it 10 years later at 300, you have made $200. If you bought 1,000 shares of that stock and you sell it 10 years later or 2 years later, you will have made $200,000. Whatever happens in between that buy and that sell is completely meaningless. And then the other way that you make money when you're buying a stock is when a company that you bought a stock of pays a dividend. And that's when the company pays out a portion of their earnings to stockholders. They usually pay dividends quarterly, but I suppose there's maybe other situations that they pay annually or semi-annually. So each stock has a ticker, which is usually a 3 to 4 letter symbol of the company. So some are really straightforward, like Facebook is FB. IBM, not surprisingly, is IBM. Some have fun tickers like Yum Brands, YUM, is the ticker for the company that owns KFC and Pizza Hut. And I have a quiz for you, Danijel. Can you figure out which company uses the ticker HOG or HOG?
Harley Davidson?
Yes!
Hey!
So there are thousands of companies. That's how we track stocks, using their tickers. And that's how also you would trade a stock. But there are thousands of individual companies that trade in the US and globally. So there's also a need to organize stocks in other ways besides just giving them tickers. So investors classify stocks in a few different ways. I'm just going to mention the 3 main ways we tend to group stocks up. Number one, by market capitalization or market cap. And that's the size of the company. So you may have heard the words small cap, mid cap, large cap. Small cap companies are companies that are worth less than $2 billion. You are probably unlikely to have heard of a lot of these companies because they're so small, even though $2 billion seems like a lot to us normal people in terms of a company that trades in the public equities market. That's a very tiny company. Mid-cap companies are companies with a capitalization or a value of somewhere between $2 and $10 billion. So these are going to be companies that are up and coming. Maybe you've heard of some of them, maybe not. And then large cap companies are companies with a market cap of $10 billion or more. And these will be large, probably very well-known companies, probably companies your grandparents have heard of. Sometimes they're also called blue chip companies. And then the second way we categorize stocks is by calling them growth or value. Growth stocks are probably going to be a lot of these small and mid-cap companies because they're in the early stages of their business and hopefully they are growing rapidly. And value companies are likely to be the larger cap companies that maybe, like I said, your grandparents will have heard of, like Pfizer, PepsiCo, Microsoft, Apple, AT&T, companies like that. They're typically considered value because of their size. And because of their size, they tend to be more stable, a little bit less volatile. They have more resources, like strong management and access to credit. And if these companies pay a dividend, all companies can pay a dividend, but typically big blue chip value companies that pay a dividend are more likely to maintain it over the long term. So when you buy a growth stock, you are typically looking for the price to go up. When you buy a value stock, sometimes you are just looking for a stable price and a reliable dividend. And then the third way we classify stocks is by industry. And there are lots and lots of different industries, like I'll just name a few: energy, financials, utilities, retail, just a few, but there are lots of industries. So for the most part, any stock will fall into one of these categories, whatever their capitalization is, whether they're growth or value, and they will almost all fall into a certain industry. So just taking another step back, stocks trade on exchanges. So there are dozens of exchanges globally, but some of the ones that you might have heard of in the United States are the NYSE, which is the New York Stock Exchange, or the NASDAQ, which is the National Association of Securities Dealers Automated Quotations. It's not easy to say. But because there are thousands of stocks that trade both in the US and abroad, the market has created indexes. And indexes are like baskets of stocks so that you can see what a group of stocks are doing at any point during the day or the week or the year. So if you want to see what financial companies are doing, you can look at the financial index. And if you want to see what the Japanese financial companies are doing, you can look at a Japanese financial index. And if you want to see what small or mid or large cap companies are doing, you can look at those indexes. So indexes are a measure of what groups of stocks are doing at any given time. So if you want to see what the financial sector is doing, instead of looking up what Bank of America and Citi and Wells Fargo and JP Morgan are all trading at that given point in the day, and then averaging up the prices to see if the whole financial sector is up or down, which by the time, as soon as you do that, the prices will have changed anyway, you could just look at the financial index. I just want to mention a couple of other indexes that you may have heard of because they help us understand the stock market. These are broad market indexes. So the S&P 500, that's 500 American stocks. People look at the S&P 500 as a proxy for what the market is doing at any given point in any given day. The Dow Jones Industrials is 30 U.S. industrial stocks. People used to look at the Dow as a measure of what the market is doing, but they don't do that quite as much anymore because industrials don't make up the whole market anymore. So that used to be a great measure of what the market is doing. It's actually not a great measure anymore. It's just not enough companies, and it's only the industrial sector. Another broad market index that you will have heard of is the NASDAQ. And the NASDAQ is the 2,500 stocks that trade on the NASDAQ exchange. And the NASDAQ stocks are something like 50% tech. So people tend to look at the NASDAQ to see what's happening in the tech sector. It's a good measure of that. And then finally, the last one I wanted to mention, which I think is actually the least well known, maybe I'm wrong, is the Wilshire 5000. And the Wilshire 5000 is all of the stocks that trade in the US, all of the actively trading stocks in the US. I don't know why it's called the Wilshire 5000 because there's only 3,700 companies that comprise it, but that is a good measure of what every stock is doing in America. So if you're interested in finding out what the broad stock market is doing at any moment of any day, whenever the market is open, you can turn on a news channel and you can look at the ticker on the bottom of the screen that says SPY. That's the ETF that tracks the S&P 500 index. And if it's green for the day, it means it's up. And if it's red for the day, it means it's down. It's a measure of what the stock market is doing, the broad market is doing at any given point in the day. But one important thing that I do want to mention is that indexes don't trade. Index funds trade. So the index exists as a group of stocks, and funds are created to mimic that basket of stocks. So SPY is the ticker for the index fund that trades, that mimics the S&P index. I hope that's not too confusing. And when a stock drops out of the S&P 500 index, the index fund gets rid of that stock and buys the new one that the index replaced it with. So this fund will perfectly mimic the index. So when you as an investor go to buy stocks, you can either buy individual stocks because you like the fundamentals of the company, like Walmart or Coca-Cola or IBM, or you can buy an index fund if you like the whole sector, like tech or retail or financials. So just to wrap up, I'm sure I'm not under 5 minutes. I'm sure I'm way over, but the stock market is a volatile thing. It is risky and it can be irrational and confusing at times, but it's also perhaps the most widespread way of growing your wealth through investing.
Thanks for tuning in to another episode of the More Than Money podcast. If you feel like you learned something or enjoyed this episode today, we ask you to do a few things. Number one, leave us a 5-star rating and a review on whatever platform you're listening to. If there's something you're struggling with and want us to cover, let us know in your review and we'll make sure to cover it soon. Second, make sure to follow Sqwire on social media and share this podcast with any workers, employees, or friends. This podcast is made possible by Sqwire, customized financial wellness program that will help you create a culture of care with happier and healthier employees day in and out. Whether you're a business owner, HR manager, or just someone trying to live your best life, Sqwire is for you. Head over to Sqwire.com to learn more about how Sqwire can transform your workforce. And that's SQWIRE.com.